Welcome to Bloomberg House, which you were just admiring and saying you'd help pay for. We were just talking earlier about how difficult it was to invest in Europe. You look at the year you've had, particularly the time since you took over Credit Suisse. Most people would say that was one of the great bargains of banking. Your share price has risen by more than 80%, now the highest since 2008, and you are now Europe's most valuable bank, so well done on that. But the first thing in terms of the year ahead is a man called Donald Trump has arrived in Washington. And I wondered, you are based in Switzerland. Switzerland is still a pretty open country in terms of trade. What do you worry about what he will do in terms of tariffs and trade?
Yeah, thank you for. Let me just take an exception on your bargain issue. So I think it's, if you add up the true cost of the acquisition, you will see that the 3 billion headlines we paid for, you had to add up at least another 15 to 17 billions for the restructuring. And therefore, it will be eventually a good transaction, but it takes time to make it work.
That's always the best sign of a banker, when he denies he's done a brilliant deal.
Thank you for telling. No, look, Trump. The new administration. First of all, I have to say that, like everything, when it starts, there is a lot of promises, a lot of ambitions, a lot of promises they make, and we'll see how much is really going to calm down effectively. I do hope, at the very least, that the new administration can deliver on its agenda on the geopolitical standpoint of view, to bring peace or ease tensions, not only in the east part of Europe, but also looking at the Middle East, and also normalize relationships with China. Of course, on the other side, the tariff topic, it's something that is quite potentially dilutive to any deregulation or easiness for doing business. So I take a positive but also balanced approach on the new administration.
Is there anything particularly on banking that you're looking for? There's been a lot of talk about deregulation. Everyone's share prices have gone up. But do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
Look, I think that the real, true, honest assessment is that the new administration is unlikely to put new regulation, which for the banking industry is already an achievement, right? So new regulation, and particularly regulation that goes in conflict with existing regulation. So hopefully we will see some simplification in terms of avoiding overlapping tasks by different agencies in the US. That would be a welcome move. I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of deregulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Just come back to that in a second, that idea that others may have to follow. But just one particular thing that's already happened in your industry is you have a variety of banks, JP Morgan, Goldman Sachs, Bank of America, they've all left the net zero banking alliance. So you're going to do that? There seems to be a general retreat from that sort of thing.
Yeah, look, I think that we have to carefully analyze the situation. We also want to see exactly what GFANZ is going to come up with in response to that. It is fair to say that the last few years, the ambition should remain the same, to help contain climate change and go towards a net zero. The reality is that it's not possible and it's not credible to think that you can do it at the same pace and the same extent in every single country and region in the world. So that one is a major issue. The second one is, which I have to say I always question and challenge. The financial services industry is not the policeman of politicians. Politicians have to take clear, coherent views on the matter and not try to ask banks to act as a policeman. So we are committed to help clients and society to achieve those targets, but we also believe that taking too much of an excessive position on denial or unrealistic short-term ambitions is not the way to help. We believe helping the transition is the most fundamental part of the equation. We need to free up resources to help the transition, and that's the reason why banking is part of the solution.
But you shouldn't be the policeman.
No.
You mentioned earlier just that idea that there might be pressure on European regulators. Many people would hope there would be a change. You are actually quite a good example of somebody who's got a problem in that respect, because you've got the Swiss government now talking about putting even more capital charges on you. I think you already have to do 20 billion to do with Basel and the existing regulation. But you now might get another 25 billion because they're talking about making you apply capital to all your overseas subsidiaries.
Well, look, first of all, I have to say that we do agree with many of the proposals of the Swiss government in respect of taking the lessons learned from the Credit Suisse failures. We believe it's quite clear that Credit Suisse went down because they had a very bad business model. They were mismanaged for too many years. That's the crude reality. And also, they benefited from incredible regulatory concessions over the years. And so we believe that a balanced approach in assessing what needs to be fixed versus what happened, where all stakeholders recognize their negative contribution to what happened, is the right solution. Putting more capital, it will only make us less competitive, less able to help our clients to grow. It's going to make banking services more expensive, and it's not going to definitely help fostering a competitive financial center. So we hope and believe that a proportionate outcome should be the solution.
But do you think you can get away with not having to put 100% capital against these foreign subsidiaries? That is the big...
I don't know. I think that's really still a quite complex discussions. We are working at working level. We are trying to present the case for why it's totally unnecessary and incredible penalizing to say that a foreign participation is worth nothing on your balance sheet. That's an extreme overreaction that will not really help foster Switzerland as a leading financial center.
If you're being punished for being Swiss, there's been talk of you moving your listing from Zurich to New York. Why not take advantage of this much better regulation somewhere else?
So I think that we are not punished for being Swiss. We are punished for being part of the solution. So, which is a quite strange concept.
You would be punished less if you were in America.
No, but look, listing is not the major factor. It's where you are domiciled and who is your leading regulator that matters. So the regulatory framework is the Swiss one. Swissness is helping us. It's a quite differentiating element. The Swiss business is one of the pillars of our strategy. We want to continue to be successful operating out of Switzerland. We will make our case till the last minute in making sure people understand not only the risk we may pose, but also the benefits we create for the country. And when that happens, then politicians should take their decisions about the future. So I don't think for me it's a topic to even consider at this stage to move away from Switzerland.
What about the European Union? All this time we have all been waiting for a banking union, for all these things that Mario Draghi had them in his report. Is Trump the wake-up call finally for Europe to look at having banking across the European Union?
Well, I think Europe seems to look like a bear sleeping during the winter. So I don't know how many wake-up calls they need. in order to, I mean, today probably with this heat here, the warm weather, maybe some of them are waking up suddenly. But if you look at, my view is that I thought that way when Brexit happened.
Yeah.
I thought Europe, that would be the wake-up call for Europe, right? Try to, So honestly, one can hope that Europe understands that being more strong and independent, and here I'm thinking about defense. I would say that is a fair comment President Trump is making about Europe putting more money behind defense. But I think that Europe should develop its own defense, and not relying so much on the U.S. For its own defense. So, by the way, that's also a good way over the years to develop innovation. So at the end of the day, I think that hopefully it's a wake-up call, but I'm not so convinced that the current state of Europe will allow that to happen. Too much fragmentation, still too many parochial views on the matter, and so.
But that's particularly true of banking, isn't it? I looked. You're worth. UBS is worth about 120 billion. As I said, you are the biggest bank on this continent, excluding sort of Britain. By contrast, JP Morgan is worth 730 billion. There's a whole stream of American banks which have got bigger because they've been allowed to merge, they've been allowed to grow. And what happened is when you merged, lots of people, including me, thought, well, finally Europe will start seeing cross-border mergers. And you've had a little bit with Commerzbank and stuff, but you have not had the kind of consolidation that most people would think was healthy for Europe.
Well, look, first of all, I think JP Morgan is a league on its own. If you go back to the next level, you're almost half of the next. And then you go down. So no, our valuation is driven by our business model. If you look at UBS, we have 60% of our revenues are coming from wealth management and asset management. So asset gathering, 20% is Swiss business, 20% is the investment bank. The only peer that is close to us is Morgan Stanley with around 55% and 45% investment bank. The average global banks in the US has 20%, 21%. The average European banks have 11%. So our multiple and valuation premium is driven by our business model, it's not a banking.
But all the same, there's no doubt. European banks are very small compared with the American ones in general, and that most people would have thought there would be a wave of deal making. And one thing is, would you be a participant in that? You've done a very successul deal. Why not do another one?
We are still digesting, so it's very difficult for us to think about dinner. So I think that when I look at true consolidation in Europe without banking union is not possible. If you look at everything that goes on right now, is de facto domestic consolidation.
Yes.
I mean, where the main driver of value creation is domestic. So European banks, we have been saying that for a while, won't be able to compete if you don't have a first banking union and a capital market union. Look at the balance sheet of European banks. We are still, and it's not an issue, but we are still basically financing a lot of things that in the US are financed by capital markets. So a lot of the resources banks use are going to different businesses, and not necessarily, in terms of profitability, better performing ones. So for one unit of risk, a US bank has a higher return than, on average, a European banks because of the role we play in the economy and in the system. So fundamentally, but in order to mobilize resources to transform Europe, to go through the transition in terms of climate changes and the investments we need to do, we need to free up resources that are not effectively used. And the capital market union and a banking union is a prerequisite for that.
Can I ask you about America, seeing you said how good it was? You're now the biggest wealth manager outside America. inside America, you're still trying to grow. Where there are other bigger ones there. And I wondered whether acquisition was a way to do that. You know, you've complained sometimes about the profitability of what you do in America. Is that the answer, or is it a question of sorting out what you already have there?
I think it's mainly sorting out what we have. We need to do a better job in managing our cost, enhancing our banking capabilities to wealth management clients. We manage $2.2 trillion of clients' assets, so we have scale. Yep. So we can't really argue about scale. But it's fair to say that we don't have all the full banking capabilities that, you know, in deposits, in loans, and that are necessary to develop that business. We can go a little bit deeper in terms of client coverage, maybe more into the high net worth affluent space. But most importantly, we have to recognize that, you know, our banking platform has elements of fixed costs that are not distributed to many businesses like our peers in the US. So we have a scale issue in that dimension, not necessarily a vertical dimension, but a horizontal dimension. Now, if you allow me, because it's very important, once we narrow the gap in terms of margins, which I believe we will do, we will never close the gap to our peers. We will have because of our uniqueness as a business model in terms of asset gathering, we will still command a premium valuation compared to many banks. So higher cost-income ratio is not necessarily the only solution. We need to really have efficiency in the way we deploy capital as a way to drive business.
Very technical one, but you do most of your stuff in America through independent fund manager. You have independents who are
financial advisory.
Financial advisors. By contrast, you know, you seem to want to do more stuff in-house. Is that a fair?
No, I think that our financial advisors are best in class. We are very well positioned in the high end in terms of segmentation of clients. The productivity of our financial advisor is very high. What is fair to say that we don't have enough institutionalized coverage of those clients. I'm going back to what I mentioned about lending and deposits and things that are creating a more balanced profitability for the bank, where, you know, right now it's fair to say that transaction and fee-based split between financial advisor and the bank is not the right business mix. So that's where we need to go. And if we do that, we help our financial advisor be even more relevant to their clients.
I'll ask you quickly about Asia. You know, you've been growing a business there. A lot of people are worried about China. Do you see your growth mainly coming outside China?
We are not worried about China. I think that, of course, things have changed in the last 5-6 years. It's more volatile, less growth. But, you know, if I look at the momentum we had in 2023, 2024, despite the huge integration we are going through, China and Asia, Greater China and Asia are still a huge driver of growth. So we remain very confident. We manage almost 700 billion of clients' assets, almost 3 times more than the next competitor. We are well positioned for future growth. And, you know, also you look at the demographics there and wealth creation in the region, it's quite clear that one cannot be a big player in wealth management without having a core and big commitments to Asia and China.
I'll ask you a couple of final questions about Credit Suisse and you. But Credit Suisse, you say you want to fully integrate it by the end of 2026. You cut 10,000 jobs. You still have roughly 110,000 people. Do you think are there more job cuts that will have to come as part of that process, or do you think you've done that?
No, look, you know, we had as a target to save 13 billion of cost of the pro forma banks end of 2022. We achieved 7.5 billion. The next 5.5 billion are going to come through rationalization of the client of the IT platforms, and also the inevitable redundancy, the painful part of the equation. Having said that, if you look at our natural attrition, it's almost around 6-7% a year. So we have been also insourcing jobs that we were outsourcing before, so limiting the numbers of proactive redundancies. So we still believe that we will be able to manage in a responsible way the inevitable fact that we need to cut costs, because we inherited a business that was losing billions structurally. So it's not about extracting synergies of two going concerns banks. First, we had to restructure Credit Suisse and then look for synergies. And that's the painful part. And, you know, in M&A, the most painful part is always the human part. So far, you know, being the competitive environment, being very active, and demography is helping. It's quite amazing because we have a lot of people going into retirements. So we hope we can mitigate.
So my last question. You previously said you're likely to stay as CEO to the end of 2026. Everything you've said throughout this seems to imply this is a massive job that's ongoing. Is there a chance you would go on further than that?
But look, you know, I really believe that leadership is not only talking about what you think you're going to do, but also what you hope you can leave to your successors to implement and develop. And so I think that, you know, we have to take short-term views on certain matters. I'm committed to execute on the integration. I'm committed to deliver a platform to my successor that can continue to grow and create value for clients and shareholders. So, you know, with the board, we are trying to figure out what is the direction of travel, and the successor has to be chosen based on her or his ability to comply with that strategy. So it's not important.
Sounds a little bit like a maybe, but we will. But that has been you have given a very good analysis of the year ahead, especially for UBS and Credit Suisse. Thank you very much, Sergio.
Thank you, John.
Thank you for coming.